If I had to start trading again from absolute zero, there's one question I would ask about every single strategy before I ever risked a dollar on it. Where is the actual evidence that this works? Not the feeling, not how clean the chart looks, the actual evidence. And that one question alone would have saved me years of frustration and a lot of blown up strategies along the way. Most beginners think successful trading comes down to finding the perfect indicator or just trusting their gut when a setup feels right. I believed that too when I started. The real problem though wasn't my ideas, it was that I had no actual way of knowing whether I was building a real edge or just fooling myself. So here are the 5 things I go back and tell myself on day one. And the last one is honestly the one that keeps most traders in the game long enough to actually succeed. First, never trust a feeling when you can rely on evidence instead. If your strategy only exists because it looks good on a chart, you're not really building a business, you're building it on assumptions. And the market doesn't care how confident you are about it. It only cares whether there's an actual statistical edge behind the trade. So before you deploy anything, ask yourself a few simple questions. Has it been tested across different market regimes? Does it hold up on other instruments too? Or does it only look impressive because you happen to pick the one clean section of history that made it shine? And this is exactly where most traders end up quietly destroying their own strategies by optimizing until the equity curve looks almost too perfect. The drawdowns disappear, the win rate keeps climbing, and it starts to feel like you finally found the Holy Grail. But in reality, it's usually the opposite happening. The cleaner the backtest looks, the more suspicious you should actually be. Your job here isn't to build something that memorizes the past. It's to build something that can survive the future. And once you understand why a perfect backtest is actually a red flag, the next question becomes pretty obvious. How do you actually test for that? Because this is exactly where almost every beginner gets it wrong without even realizing it. You test a strategy on 10 years of data. It performs okay, so you tweak one parameter, and it gets a bit better. You adjust an indicator, better again. Maybe you add one more filter because it removes a couple losing trades. Repeat that process 30 or 40 times, and at some point you're no longer discovering an edge, you're just teaching your strategy to memorize the past. So a beautiful equity curve by itself really doesn't mean much. The only question that actually matters is whether it holds up on data it's never seen before. There's really 2 tools that fix this for me. First is out-of-sample testing, where you build the strategy on one slice of your data and only test it, completely untouched, on a slice you never even looked at. If it holds up there, that's a genuinely good sign. And second, the one I personally never skip, is walk-forward analysis. Instead of testing once, you optimize on one window, test it on the next window, then roll it forward and just repeat that over and over across dozens of periods. It's honestly the closest thing to how a strategy actually behaves in the real market, where conditions never really sit still. You're not looking for perfection in any single window here. You're looking for consistency across all of them. But even a strategy that survives walk forward can still fail on you, and for a completely different reason. A lot of beginners assume more indicators automatically means a stronger strategy. But complexity doesn't really create an edge. In most cases, it quietly destroys one. Every extra rule you add is just one more opportunity to accidentally fit your strategy to the past instead of to the actual market. A good strategy should have a story you can explain in a few sentences. Maybe you're harvesting a trend premium. Maybe you're exploiting a behavioral bias. Maybe there's just a structural reason a certain type of order flow keeps mispricing an asset. But if you need 20 conditions to explain why it works, you probably don't actually know why it works. And neither will your strategy the first time the market shifts on you. So simple isn't really a compromise here. Simple is what survives because simple rules are easier to test, easier to trust, and honestly a lot harder to accidentally overfit. This is really the mindset shift that separates traders who last from traders who blow up after a lucky streak. And one of the biggest traps in trading is judging yourself based on the result of a single trade. A win doesn't mean you actually made a good decision. A loss doesn't mean you made a mistake either. You followed your rules, you sized it correctly, and the market just did what markets sometimes do. That loss is simply noise inside a distribution you already expected going in. But bad process, winning trade, that's actually the dangerous one, because that's when traders learn exactly the wrong lesson. They broke their own rules, got lucky, and now they believe that's how it's supposed to work. And the market always recups such profits later on. Your job here isn't to win every single trade. It's to make high-quality decisions repeated across hundreds of trades and let that process compound over time. The outcome of any one trade is mostly just noise. The process is what actually produces the long-term result. Once process becomes your scoreboard instead of your P&L, something else starts to make sense too. You should rely on a portfolio of strategies instead of only one single strategy. Even your best strategy is going to go through stretches where it just stops working. So, a market shift, participants change, and whatever edge you originally found can slowly erode without much warning. This is also called alpha decay. A lot of traders spend years hunting for the one system that works forever, and it just doesn't exist. A much more realistic goal is a portfolio, not a masterpiece. But there is also a trap. 5 strategies treating the same market, on the same time frame, reacting to the same conditions. That's not really 5 strategies. That's basically one strategy wearing 5 different outfits. So when the environment turns, all 5 fail together. A real portfolio is built on strategies that are uncorrelated. One strategy follows trends, one is fading extremes. Maybe one is running in a completely different market entirely. The goal was never that every single strategy wins. The goal is just that they don't all lose on the same day. But you don't have to put your entire portfolio together in a single month. Even professional researchers and quant funds fail constantly. They just expect it going in. Nobody sits down, tests 30 ideas, and assumes all 30 are going to work. Most of them test 50, 60, sometimes way more, just to find the one that's actually worth developing further. And that's not a bad ratio, that's just the job. The research process was never really about finding a winner on your first try. It's about eliminating bad ideas fast and gathering enough evidence until something finally proves itself out. So if your first 10 strategies fail, that doesn't mean you're bad at trading. It just means you're doing exactly what every serious researcher does. You're searching. The only real mistake here is quitting the process because you expected every idea to just work on the first attempt.